Hey, what's up, everybody? This is Sunko, the Korean Bro. Today's 2024, April 15. Hmm. Let's see what articles we have tonight, okay? Profit surge at Goldman Sachs on Wall Street revival. Hmm. Okay. Warren Buffett could have bought any of 378 S&P 500 companies with $74 billion. Instead, he piled it all into one beloved uh, stock. Over the course of 6 decades, Berkshire Hathaway CEO Warren Buffett has put on a clinic for Wall Street and everyday investors. Okay, where is the broad-based S&P 500 is nearing a total return, including dividend paid of 34,000% since the affably named Wark of Omaha became CEO in the mid-1960s. Buffett has overseen a jaw-dropping aggregate gain of nearly 5,000. Hold on. Okay, 100,000% for his company Class A shares. Even the Buffett is just as fallible as an investor. He and his top investment aides, which until his recent passing included the architect of Berkshire Hathaway, Charlie Munger, have demonstrated a knack for finding bargains hiding in plain sight. Decades of sustained outperformance of the S&P 500 is why professional and everyday investors wait on the edge of their proverbial seats to find out what stocks Buffett and his team have been buying and selling. Not this one. Okay, let's move on to mollyfood.com. Mm, ETFs provide a quick, convenient way for investors to obtain diversification. Mid-cap focused ETFs can provide exposure beyond the big-cap giants. ETFs that target smaller stocks are a further way to spread your exposure. Okay, $500 won't get you very far. If you're looking for diversification on the stock market, shares of many successful companies are trading for about that price all on their own. So yeah, your investing dollars can stretch much further when you are shopping for exchange traded funds. These funds allow you to purchase a basket of stocks in one simple transaction, giving you an efficient way to gain exposure to a sector, an investing style, or even the entire market. But which fund should you buy? When indexes trading near all-time highs, it can make sense to try to balance your investments by purchasing parts of the market that haven't rallied as much. In this case, that includes many stocks outside of the large cap tech giants that have powered recent stock market gains. Let's take a closer look at two popular ETFs that cover your bases well in this arena. Vanguard Mid-Cap ETF is an index fund that passively tracks the performance of medium-sized companies. The focus means there's no danger of adding excess exposure to the handful of giant stocks that have driven most of the market's returns in recent months. Apple and Microsoft, valued at $2.6 trillion and $3 trillion respectively, won't be found in this ETF. Hmm. So yeah, you will get exposure to over 300 mid-cap stocks across all market sectors. The ETF tilts toward value as well, with the average price earnings ratio of its portfolio landing at 21 compared to the S&P 500 PE multiple of 24. So I'm just gonna skip on this one because mid-cap size business is none of my interest. Small cap value ETF, I'll pass on this one too. Hmm. Okay. We'll see about this one. It's been long since I read market news about Nvidia, so we'll go and see and what articles we have with Nvidia. Okay, Nvidia is estimated to control 80% of the market for chips used for AI, and that lucrative position provides the company with tremendous profits to fund years of innovation. The company's graphics processing units are used by OpenAI's ChatGPT and all the leading cloud services. Nvidia posted triple-digit revenue growth last year, with demand pointing to another strong year of growth in 2024. So, okay, the stock has climbed 78% just since the beginning of the year, but that's largely because investors are still catching up to the incredible growth the company is experiencing. Surging demand for its GPU systems pushed Nvidia's adjusted profits up 286% last year to $32 billion. In March, Nvidia unveiled the new Blackwell GPU-based platform that features dual 8 billion transistors providing the computing power for generative AI requirements. Amazon, Tesla, Meta platforms, Microsoft are among some of the companies expected to adopt Blackwell. Okay, so all the major companies use what NVIDIA produces. Okay, so I wouldn't underestimate the company's ability to keep growing for many years. Wall Street analysts have been raising their growth forecast and currently expect NVIDIA's earnings to grow at 35% per year on an annualized basis, which stocks for price earnings ratio at 36. It still offers attractive and long-term return potential. So price to earnings ratio is about 36, which is not a you know large number that I had expected. I was expecting like 106 PE ratio, but it's a lot less than that. Hmm. Okay, we'll see about supermicro computer, Amazon, Alphabet. Hmm. Now let's read one by one, okay? Okay, with the S&P 500 climbing standings gain in this bull market, you may wonder if it's too late to get it on the action. But I've got some good news for you. When you invest over the long term, at least 5 years, you'll find great investing opportunities during any market environment. Investing time is on your side, offering you the chance to benefit as the company evolves and delivers on the various promises from product launches to earning growth. Today's a particularly interesting moment to invest in technology as we have for what could be the next revolution in this field, artificial intelligence. Some AI stocks have soared, while others haven't yet gained momentum. And in both of these areas, you'll find players likely to gain over the long term. That's why if you have $50,000 or even a smaller amount, you don't need for everyday expenses. You want to grow over time. It's a fantastic idea to invest in a basket of tech stocks that may benefit from the AI boom. So, okay, supermicro computer. Stock has soared a mind-boggling 2,200% over the past 3 years. So you may hesitate to get in on the story now, but this actually could be just the beginning of Supermicro's growth story because we are in the early days of AI development. And Supermicro can benefit from growth of all of the top AI chip makers. Mm. This is because the maker of servers, full rack scale solutions, and other equipment needed for AI include chips of these players in systems. Need to follow their product development closely so they can immediately make these innovations available to its customers. Supermicro said recently that it's seeing ongoing record demand for its rack scale solutions for AI, including some of these best selling chips. And new releases, such as the upcoming launch of NVIDIA's Blackwell architecture, could further boost orders. All of this should translate into ongoing earnings growth well into the future and push the shares higher. So what's about Intel? Uh okay. Hmm. Intel is the leading maker of central processing units, the key component of a computer, but Intel hasn't yet benefited from the excitement surrounding AI. The chip maker fell behind in the AI space, and that's been one of the elements weighing on its shares. But things may be about to change for two reasons. Intel recently launched a new portfolio of AI products, including its Gaudi 3 AI accelerator that may even challenge NVIDIA's H100 chip. So Intel is about to produce one that's going to compete against Gaudi AI 3 AI accelerators. Okay, its name is 800. Of course, NVIDIA is preparing to launch its most powerful chip ever based on the Blackwell architecture, as mentioned above, so I don't expect Intel to beat this market leader. But it doesn't have to. Gaudi 3's performance and affordability could help it carve out enough market share to boost Intel's earnings and eventually share price over time. Intel's second bit of good news, the company is opening up its manufacturer mm, to others, and this could result in a whole new growth driver as this AI boom continues. And last but not least, we have Amazon here. Amazon is like one of my favorites. Um, it's got everything pretty much. The sectors that they're working on are about like five sectors. Uh, and to name a few, mm, e-commerce, um, data center, and what else are they working on? Let's see, cloud service, AWS, Amazon Web Service. Amazon has a long track record of earnings growth thanks to its leadership in the high growth markets of e-commerce and cloud computing. And this is likely to continue as the company has invested to help it maintain leadership here. In e-commerce, Amazon has revamped its fulfillment network to make deliveries faster, a move that pleases customers and makes Amazon more cost efficient. As for cloud computing, AI is to step play a big role in growth moving forward. Amazon Web Services is heavily investing to serve the AI customers every need, from the basics like chips and software to fully managed services. That allows customers to tailor popular large language models for their own use. This should help AWS keep its long-held position as the world's number one cloud computing services provider and lift revenue over time. That's particularly good news because AWS historically has been the driver of overall profit at Amazon. And all of this means Amazon stock has plenty of room to run even after recent gains. Okay, Alphabet is known for helping most of us on a daily basis. It's the owner of Google Search, the search engine with more than 90% share of the global search market. Alphabet's top business even has managed to enter our language, with people often answering a question with "Let's Google it." And now Alphabet's investment in AI is likely to further strengthen the company's leadership in the search market. Alphabet recently launched Gemini, its most advanced AI model yet, and is incorporating AI in all products and services, including search. The move is making search better and making the advertising processes easier. And this should uh, keep advertising revenue climbing. This is key because Alpha makes most of its revenue through Google advertising. Alphabet also offers investors a solid track record of earnings growth, and even during the recent difficult economic times, advertising revenue held up pretty well. That makes this company one of the safest AI bets on my list, and a great place to park a portion of your $50,000 today. Okay, move on to next article. We got Intelia and Modona. Let's see about Intelia. Okay, Intelia works in the exciting field of CRISPR gene editing. Okay, let's skip and move on to the next one. Hmm. Okay, let's read this one. Amazon's online shopping division is still growing quickly and seeing improved profitability. The cloud computing division is benefiting from artificial intelligence spending. Investors who hold over the long term can still see solid returns, but it will pay to be patient. Okay, the technology stock has reached all-time highs again. Where does it go from here? The last few months have been delightful for shareholders of Amazon. Stock is up 45%, last 6 months and 22% year to date. Hmm. With a market cap of a $1.93 trillion, the shares recently surpassed all-time highs set in 2021 as investors become increasingly optimistic about profitability in its e-commerce operations and resurgent growth in cloud computing due to the recent boom in artificial intelligence. Amazon stock is now up 100% in the last 5 years. But what do the next 5 years look like? Can it repeat this stellar performance and double yet again? Let's take a look. E-commerce profit inflation, more growth ahead. Even though the online store is now closing in on 30 years of operations, Amazon's e-commerce's global retail operations are still growing quickly. North American sales increased 12% in 2023 to $353 billion, with international operations growing 11% to $131.2 billion. Even though Amazon's platform is so dominant within the e-commerce sector, online shopping makes up only an estimated 15.6% of retail sales in the United States today. So it only an estimated 15.6% of retail sales. 15.6%. That's crazy, right? Okay, if that number can consistently rise over the next up 10 to 20 years and Amazon can maintain its market share, there are still many years left to increase its sales. The best part about this growth at Amazon's e-commerce division is where it is coming from. Third-party seller services were up by 19% year over year last quarter, and advertising services increased 26%. These high margin segments can drive overall profit margins higher if they keep growing quickly. And that is exactly what we're seeing today. North American operating margin hit 6.1% in the fourth quarter of 2023, expanding for each of the last 6 quarters and reversing from negative 0.3% in the fourth quarter of 2023. In 2024, investors should expect e-commerce profit margins to continue climbing higher. A cloud computing rebound. The most profitable segment at the company is its cloud computing division, Amazon Web Services. In 2023, it generated over $90 billion in sales and $24.6 billion in operating income, giving it a profit margin of 27.1%. However, back in late 2022 and early 2023, there were major concerns about a slowdown in AWS. Revenue growth fell from a 28% in the 2022 third quarter to 12% in the 2023 second quarter as company helped its software customers save on cost after the height of the pandemic. Today, these concerns have proved to be too pessimistic. AWS revenue accelerated in the fourth quarter to 13% growth, which has sent the stock higher. In 2024 and 2025, revenue looks promising with the rapid rise in AI services. These new products use a ton of cloud computing to operate, and AWS is looking to be one of the leaders in this space along with Alphabet's Google Cloud and Microsoft Azure. For example, the company signed an extensive agreement in space with fast-growing startup Anthropic. Over the next decade and beyond, analysts expect cloud computing to continue its ascent, increasing at a double-digit annual rate. If Amazon can maintain its market share lead as it has in e-commerce, AWS should have many years of growth left ahead. So, where will Amazon stock be in 5 years? To estimate where the stock will be 5 years from now, we need to make some profit estimate for both e-commerce and AWS. Let's assume that e-commerce, excluding the unprofitable international segment, can grow sales by 12% annually over the next 5 years and expand profit margins to 10%. So they would put 2028 North American retail profit at $62 billion. Doing the same for AWS, let's assume 5 years of 12% growth and profit margins that remain at 27% in 2028. That would equate to $43 billion in AWS profits at both numbers together, and you get $105 billion in earnings from Amazon in 2028. And that excludes any upside from other divisions such as international e-commerce or satellite international services. Now comes the hardest part. What earnings multiple would Amazon trade at in 2028? An exact answer is impossible, but with a wide competitive advantage in both cloud computing and e-commerce, I think the stock deserves trade at an above market multiple of 30 times earnings. So, otherwise known as the price to earnings ratio. Multiply $105 billion by 30, and you get a market cap of $3.15 trillion, or 66% boost from today's price. While not a doubling, it looks like Amazon still has upside for shareholders, waiting for the long owl. Okay, let's read this one. Broadcom. Okay, Broadcom, leading high-speed networking solutions provider. Leading high-speed networking solutions provider. Broadcom came out with solid results in the recent quarter, with both revenue and earnings easily surpassing consensus estimate. Investors, however, seem to be disappointed with the company's weaker than expected guidance for fiscal 2024. This has affected the company's share price performance in the past month. Despite this, there are still several reasons for long-term investors to like the stock. Okay, first, Broadcom is witnessing solid demand for its artificial intelligence optimized accelerators and AI related networking components such as Tomahawk 5 800G switches, Ethernet digital signal processing platforms, and optical components from hyperscaler customers and large scale enterprise deploying on premise AI data centers. Okay, AI related networking components and artificial intelligence optimized accelerators. Hmm. So this is evident considering that the company's AI revenue quadrupled year over year to $2.3 billion in the fourth quarter. Broadcom now expects AI revenue to account for nearly 35% of its fiscal 2024 revenue at over $10 billion, significantly up from the prior estimate of 25%. Mm. Okay, now there you go. Mm. Second, it's very difficult for new competitors to enter the custom AI accelerator business. Custom AI accelerator business. Okay. As it requires companies to collaborate with large clients over multiple years and create a supporting software ecosystems. Hmm. So Broadcom has partnered with two large hyperscalers for multiple years. Hence, the company is well positioned to capitalize on the growth in the customized AI accelerator market. Third, the acquisition of VMware is playing a pivotal role in driving up Broadcom's infrastructure software revenue. In the first quarter, the company's infrastructure revenue was up by 153% year over year to $4.6 billion. VMware accounted for $2.1 billion in revenue during 10.5 week long contribution to Broadcom's first quarter results. The company expects VMware's revenue to grow at a double-digit percentage sequentially throughout fiscal 2024. Broadcom's VMware strategy mainly rationally upselling VMware Cloud Foundation to customers already running workloads with VMware vSphere virtualization platform. So VCF is a complete software stack that virtualizes customers' data centers by helping create an on-premise self-service cloud platform alternative to the public cloud. VCF is an all-encompassing to run high-performance computation and AI workloads without compromising privacy. Plus, VMware's partnership But NVIDIA is also enabling customers to run advanced AI models with the VCF. In all fairness, Broadcom's price sales ratio of 16.5 times is quite expensive compared to its historical 5-year average valuation of 9.2 times. However, despite this, considering its many solid tailwinds, Broadcom seems to be well positioned for a robust growth trajectory in the coming months. Okay. Listen. Okay, get started investing right now. The more time you give your money to grow, the less you'll need to invest each month to reach $1 million. Thanks to compound growth, your investment will accumulate exponentially faster over time. Getting started as soon as possible then is key to maximizing your earnings. Even if you can't afford to invest much right now, every year counts. For example, let's say you're earning a modest 9% average annual return on your investment, which is just under the market historical average. Here's approximately how much you need to invest each month to reach $1 million, depending on how many years you have to save. It's never too early to start investing. The sooner you begin, the easier it will be to build a substantial amount of wealth. And always invest more later if you can swing it. You won't get this precious time back. It can be nerve-wracking trying to determine the best time to buy. Many people are understandably worried about investing right before prices drop, and it can be tempting to hold off on buying until the perfect moment. However, there is never going to be a perfect time to invest in the stock market, and the longer you wait to invest, the harder it will be to catch up later. What may seem counterintuitive, it's often safer to simply invest consistently no matter what the top market is doing. So this approach is called dollar cost averaging. It involves investing set amount at regular intervals throughout the year. Sometimes you will end up buying when prices are at their peaks, and other times you will snag investment steep discounts. Over time, those highs and lows should average out. Dollar cost averaging can help take the guesswork out of when to buy, making it easier to invest consistently. Again, time is your most valuable resource when building wealth, so consistency is key to reaching $1 million or more. All investments are subject to short-term volatility, but stocks from a healthy companies with solid underlying fundamentals have the best chance of recovering from a downturns and earning positive long-term returns. Okay, let's see about Amazon. A once-in-a-generation investment opportunity. One Warren Buffett and Kathy with artificial intelligence stock to value hand over fist before it started 16%. Amazon spent much of 2023 returning to growth in its core e-commerce and cloud computing operations. Amazon generated staggering levels of free cash flow, which it is using to invest in artificial intelligence. So, despite the company's progress in AI, Amazon stock is still valued at a steep discount to its peers based on certain valuation metrics. Staggering levels of free cash flow. Okay. So, okay, here, cash flow is king. The last couple of years have been challenging for Amazon. The macroeconomy has been, um, Okay, tonight this is it, and I'm gonna see you tomorrow. Okay, I have to put an end to it. There's something that I have to do. Okay. Anyway, this is it, and tonight see y'all and have a good night. Okay, bye bye.